Hi, everybody. Good afternoon. Yeah, people strolling in. Yeah. Good afternoon, Terence, as well.
Hey, hi Ethan. Hi everyone.
Yeah. Okay, we have a lot of attendees coming in. Okay. All right. We're gonna start in the next few minutes, lah. Okay. So this is an update of the live market commentary with Terence, right? So we usually do it bi-weekly, I guess.
Mm-hmm.
Yeah, so if people who cannot hear, right, can you just type into the chat box? Who can hear, I mean, just
Chat
type
box
yes.
right now.
Yeah, just type yes if you all can hear loud and clear. Okay, yes, yes, yes. Thank you for the support. Okay, guys, no need to raise the hand lah. Lower your hands.
Are you raising hands? How come I can't see raising hands?
No worries.
Okay, if you find that it's too echoey, well actually there's nothing I can do with echoey, but then if it's not loud enough, you can just give me a shout like but I'll be concentrating on the slide. So you probably have to like put it in caps at the side so I can look at it and I realize and I know that I'm not speaking loud enough. Thanks, David.
Okay, same rules, guys. If you have any questions in for Terence, right, please put it in the Q&A. Okay, not this chat. Okay, thanks, guys. House rules, huh? Okay, we're gonna start in the next 2 minutes lah. People are still streaming in.
Okay, I'm gonna power up the slides first, right? Ethan, clear on your side?
Yes,
Okay.
very clear.
Okay, now the chat is totally gone, so I cannot see anything that you're writing right now because this whole screen is taken up by my. Is this normal or?
Yeah, it's normal.
It is normal,
Yeah,
right?
yeah, it's normal. So I
Okay.
think the Q&A, you all can type it in first. Then after his presentation, Terence will take the floor to answer the questions lah.
Yeah, I'm gonna take the cue from Ethan. Ethan, because Ethan or David, you have my mobile. So if you can't hear anything, I see Sun Young's name too. So Sun Young, if you all have any like problems hearing me, just text me and I'll be like looking out because I can't see anything on the chat right now.
Sure. Okay, without further ado, it's 12:01 p.m. and let's start. Right? Thanks, Terence. You can take the mic.
Thanks, Ethan, and welcome everybody once again. It's been, I think, 2 weeks since we last met, and if you're in the SGX conference, I was there too. I tend to do these webinars a little bit more frequently right now because I think that these are really, really extraordinary times. If you just look at the market over the last 2 months, you know exactly what I'm talking about. First, at the end of from end Feb all the way till the start of the mid of March, you can see like the markets got whacked really hard and it got hit, you know, all the way up to 23rd of March, I believe, and that's when the market started to spring back up. You can see within a 2 month period, and I think that this is really extraordinary, is really very unprecedented. You have the bear market in 1 month, and within the next 3 weeks, you saw a bull market because it came off by 30% and bounced back up by about 30%. We are still about 15% or so away from the highs that we visited, and I'm talking the US markets. In Singapore, it's slightly different, but yet you can see that V-shaped bounce that is, I believe, very atypical for such a short period of time. Of course, some of the main catalysts, and the main catalyst would likely be this QE infinity that the Fed has been talking about. Initially they were talking about, I don't know, $700 billion that was going to come up. Not enough. People were definitely hungry for a lot more. They feel that this is a really crazy virus going out there, unprecedented times, and therefore we need more. And they have really and the Fed had came out to say that they will do all that they can to actually stop this. So they poured in a lot of money. There's a lot of potential printing of money. Is basically quantitative easing that we've seen over the last 10 years, except that this time it's many big bazookas that's firing at one point in time. But from what I read, actually, Q infinity is really not infinite. There probably are certain limitations, and we're talking about anywhere between $8 to $9 trillion that they can fire out. Another event, obviously, that made investors very, very happy, or at least coming back into the market, was that they think that the curve is actually flattening. Sure, there's like very inconvenient, great lockdowns across the globe, but this is also helping places like in Europe and in the United States. They're talking about opening up again, though that's subjected to debate. And then the curve will flatten, people will come back to work, there's some semblance of normalcy returning, and therefore people are rushing back into the markets. So have you seen the bottom? I get this a lot. I mean, people have been messaging me, have been emailing me and asking me, hey, Terence, this is the bottom, right? I mean, like they are coming out, in very, very like large terms. They say that they will come into to support the market, to support the economy, and therefore the worst is behind. And then there are some houses that actually said that we have hit the bottom. Whether this is the beginning of another bull run, that's another question. But actually, that's actually the same question. But on the question of whether we have hit a bottom, that has been on a lot of people's minds. They think that at least we have formed a floor. But if you look at the headlines that's out there, doesn't lend a lot of confidence. First, I mean, you can hear over the past week, IMF, they've been saying that 170 global economies will be shrinking, and this they said that a few weeks back, and they said that this may be a little bit too optimistic. It really boggles my mind because the first webinar that I did with Investing Note, I remember telling you that was in mid March. That was before MPI came out with the big or lowering of the economic projection. A lot of economists were still expecting growth in Singapore. To me, I was saying that it's so obvious. There is definitely going to be a recession. Again, right now, I'm at the saying that there are it's going to be a major recession. Advanced economies will go down by about 6.1%. Emerging economies will go down by 1%. And if you strike off China, because China, they're still projecting growth. I think that's debatable. If you strike off China, the rest of the emerging markets are going down by 2.2%. So we are in for a very, very rough ride. In fact, it is going to be the worst economic meltdown since Great Depression. My first webinar, I really said that this is easily worse than the GFC or the Great Recession that the Americans call. And I said that it could be anywhere between the GFC and the Great Depression. But right now, it's like tending towards the Great Depression. We've never seen such things before. I've never seen it. And I've said many times, people one generation ahead of me haven't seen this level or this magnitude of pain. And the unemployment is really already showing 1 month. 1 month, and we see the unemployment going down tremendously. Look more further in the United States, we have already like witnessed 22 million unemployed. They're going for unemployment, they're filing for unemployment claims. And to put it into perspective, there's 150 million working adults in the US. 22 million filed for it. How big is it? Over the last 12 years since the Great Recession or the GFC, about 21 or 22 to 24 million jobs were being created. But in the span of 4 weeks, we have already lost 22 million jobs. That totally wipes out everything that was gained over the last 8-10 years. In other very rich jurisdictions like North Europe, Norway is already seeing unemployment at its worst since World War II. And for countries that are very, very close to us, places like Indonesia and Thailand, they're really feeling that, hey, a lot of them are hand to mouth. They need the salary that they make every day, but they are being locked down. They are stuck in their houses. They cannot make money, and therefore they cannot feed their family. They are going to fall in poverty, abject poverty. And I feel that this is not going to end so simply. It is not something that is just economic related. It is not just easily a recession. It's a deep recession that will have social political implications. And by social implications, I do mean that there could be potential for riots. And we've seen that since 97, 98, during the Asian financial crisis, that could potentially happen. Closer to home, we've seen very, very uncomfortable headlines. In Leong, one of the largest companies run by OK Lim, he's one of the richest men in Singapore. He owes suddenly, like within a span of a few weeks, you can see the headlines: $4.25 billion that he owes the banks. And these banks, three of them are the local ones: DBS, OCBC, UOB. DBS always feature during one of these, whenever there's some problems with big companies. So DBS is out there. I believe that the exposure to them is about 290 million. So all in, the three big banks that we have in Singapore, 600 million US dollars exposure to Kim Leong alone. And I think that this is just scratching the surface. It is one of the many. And when one falls, it's a domino effect. There will be others that will feel it. And later on, I'm sure there will be questions about the banks. And when there's question about banks, we are likely going to be talking we are talking about NPLs, and we're already seeing that in the United States. Of course, if you look at the data, I don't even have to like any data that you pick, it will be ugly. It's just a matter of whether is it gonna be ugly, very ugly, or downright ugly. So and expectations have been moderated, have been lowered, have been wet, but yet I think that the actual numbers far outstrip the expectations. You look at, I'm not only talking about the US, we're talking about globally, China. Some people were very, very buoyed, by the fact that, manufacturing data has bumped up. It's very easy to see why. When you have 2 months of doing nothing and finally you do something, to jump up from 30 over, on the PMI to 50 or 60 over, that is not unfathomable. But if you look at the overall GDP, it is still sliding by a mile. We're talking about minus 6.8% for the first quarter in China. And if you look at the markets overall, STI components, we are down after that dip and that very, very fast rush up. We're talking about only a 17% fall since the last week of February. That was the start, of the tumble. But in the GFC, we saw the STI components go down by 46%. And yet I'm telling you that this is going to be worse than GFC. Easily, by a mile. It makes GFC like a stroll in the park. Then I have very, very readily, actually not only now, but the last few webinars I've already concluded that we are in the midst of a bear rally. It is not uncommon to see a bear rally. If you just track back since year 2000, I think you've seen at least 10 episodes of bear rallies. And when you have bear rallies, they don't go up just by 2, 3, 4%. That's not a bear rally. We are talking about in excess of 10% over the last 10 rounds since year 2000. And if you look at the United States S&P, because it's the broadest measure, we have seen many, and in fact, every major fall, whether is it the oil crisis in the 1970s, whether is it 1987, the dot-com crash, 911, and the Great Recession, all these comes with 2 or 3 very major bear rallies that can be in excess of 20 to 30%. So what we saw recently is not an anomaly. It's probably something that has happened. It is something that has happened over the last, like decades. Whenever you see a run, in fact, the Great Depression. I think this is what I've read. In the Great Depression, there were like 10 or 20 episodes of bear rallies, and each one of them can be 10-20%. So we have to watch out for that. We are only, I think, 25 days in to this since the start of the rally. It may end very soon. And what could make it end? One of them will be, if you look at the earnings season. We are right now coming on stream full-fledged into the earnings season in the US and everywhere else in the world. Current expectations, that the peak to trough decline in earnings will be much shallower than the previous two recessions. They didn't outright say it, but then if you look from the projections, it seems very much like it. In fact, if you look at the past recessions, it actually took 3 to 4 years for quarterly earnings to return to pre-recession levels. Right now, we are not expecting such things because of the expectations. And if you look at it, I feel that analysts are still far too bullish. I've been an analyst for most of my professional life. For 16 years, I've seen a couple of really big tumbles, right? There's the dot-com, SARS period, there was GFC, there was the Euro crisis. And I feel that for every one of these crises, analysts have more often than not been behind the curve. We're not very good at like slashing earnings because we don't think about the worst case scenario. I mean, that's one. Another thing is that, as a broker, we do want you to buy, right? Rather than sell and just forget about it. So there must be certain level of activity. And therefore I say that they are still too bullish right now. If you look at the EPS estimates in the United States, and because it's a bellwether, I'm using the United States because it's a bellwether, it's happening in Singapore too. And I can give you quite a few examples. So in the US, we're expecting only about 7 to 8% decline, between 7 and 8% decline for 2020 and 2021. 2021, I cannot say because it's like, in fact, like after lunch, it's already too far away. So we're talking about next year. I really cannot tell what's going to happen next year. But for 2020, I can be dead sure that the EPS is not only going to decline by 7%. GFC was down 40%. We have to think big because this virus or this pandemic is something that no one can imagine the depth of it. But to have earnings go down by 7%, that's really too optimistic. I think that what could possibly happen is that as the results roll in and as the management come out to tell you that we can no longer do projections. I can't tell you what's going to happen even the next quarter. Don't mention the rest of the year. Like Starbucks have done that. They've really dropped, their quarterly estimates. So we can't do it. And therefore, we can, and therefore, it is really a blank to me. So if it is a blank sheet to management, what more us? How are we going to tell? What basis are we going to use to estimate how much the stock is worth? I think that there will be some fear that will set in. This will create the next wave of sell down. So I mean, in summary, I think that this market optimism from the major economies are really it's really a little bit too much, too fast, and we cannot turn on the economies. We cannot turn on like a light switch. Like say, oh, when people go back to work, that's the end of the lockdown. Immediately, there's some form of a revenge spending. I don't think that is the case because people, like we look at how dire the situation is out there. We are also a little bit uncomfortable to go in to spend big time. I believe that many people, many businesses will spend within their means, way within their means. And with regards to the stimulus, I think that too much credit is being given. Obviously, that allayed a lot of concerns in the third week of March. But going ahead, there could be people will forget about this, when there's a big market sell down. And the pace of the rebound that we're seeing was very, very fierce. But like I mentioned earlier on, these are bear market rallies. We have seen that before. So we should not take that as a sign that the market has bottomed. Remember, it's really back to the economy. It's really back to the earnings. Of course, we say that, hey, but the stock market is forward-looking. Shouldn't we think about it in 6 or 9 months ahead? Yeah, that's what I'm doing. But yet, I still see that it's still very much of a blur, and I don't think that there's any crime or any sin to shore up your cash and to wait for a better time to enter the market. Because if experts cannot really see, or the management themselves can't tell how bad the situation is going to be, what makes us think that as mere mortals, people that don't run the businesses, people that are not professional managers, could think better and further ahead? We should not run ahead of the curve. And this is, very recently, this was what we did in Singapore. The first case of coronavirus, COVID-19, or even before it was known as COVID-19 back then, in late January, when we first learned about the first case, there was a dip. And I remember the dip came, for 2 weeks. There was a slight dip. Then immediately the market started to spike up a U-turn. Why? Because they look at the SARS experience. Back during the SARS days, it did in March, and by May, even before WHO said that Singapore was SARS free, they only did it in July. The markets really started to make a V-shaped recovery, and a lot of people were thinking that this is going to be like SARS, or the swine flu, things that will blow over. But this is way, way bigger than anything that we've experienced. And therefore, I believe that this is not something that we can take lightly. This run-up, I'm very, very convinced that it's too fierce and it doesn't respect the virus enough. So with that, I've come on to my final slide. If you've got any queries, you can always pop by my Facebook or my investing note page to ask me questions, or look at some of. I also try to meet up with. I can't meet up with management right now, but I try to do e-meetups and kind of a summary of what some of the companies are doing. So feel free to come on to my Facebook page and give it a like. Okay. How should I should stop the share right now. And I will power up the Q&A. Ethan, you there?
Yep.
Okay.
It's okay, yeah.
Okay, Ken. So I'll dive straight into it. JM, has the recent stock market rally provided you confidence that a market bottom has formed? Not at all. I don't think that we can tell that it is a market bottom right now. Sure, like I said, the Fed stimulus has been very, very strong, but there are a lot of negatives out there that we have not taken into consideration. We feel that once the curve is flattened and people go back to work, and the potential of a vaccine that can be found, all these things put together, it will equal that the markets will start to run up. But I'm saying that this lockdown, even till now, I think have very, very damaging effects on the economies, global economies. We're not talking about just Singapore, just Asia or the US, but everywhere else out there. And it is more damaging and the magnitude is a lot bigger than what we are accustomed to. And therefore, it will last longer. And not only is it the economy, mind you, a lot of social implications. I mentioned a little bit about Indonesia just now, but you can just use that to a lot of other emerging markets. Indonesia, you have Thailand, you have India, you have South America, and Africa hasn't even come up with their numbers yet because of the lack of testing. So I think we are in for a very rough ride. So and let's assume that the Fed comes in with QE infinity, it works. They pour in trillions of dollars, and there's not inflation doesn't go crazy, right? It's well contained. So the Americans are happy. But many other countries cannot have this firepower. They won't be able to print money like what the US do. Because US dollars, they are coveted global currency as a safe haven. People want it, right? But other currencies, not many people want it, especially when you're going bust. So there's no ability for them to print money the way the US can, especially emerging markets. And many of these emerging markets, that's what they need most. I mean, they are really overwhelmed with debt, and they're overwhelmed with US dollar debt. And you can see the currency spiking up, the dollar spiking up against their own currencies. They don't have money to pay. A lot of the corporates don't have money to pay. The sovereigns don't have money to pay. That is going to be an issue. So is the US government going to save every country out there? I say it's really, really tough. Going forward, if they can't, okay, this one is asked by Jane, Jane Wong. Going forward, if the economy is so bad as claimed by experts, why markets still going higher? What's your views? What are your views on this? Very easy. Bear market rally. There's faith that there will once the virus the curve is flattened, people will come back. People will come back in a very fierce way. There's revenge spending. I remember reading about this case whereby after Guangzhou was open, the MS store, for the famous Birkin bags, that sold at minimum US $10,000 per bag. There was revenge spending. They come out and they start to spend like crazy. I think on that very day, there was $3.7 million worth of orders. That is an anomaly. We don't expect that because most of the time, I think people, like I said, they will still be very, very afraid to spend, and because there's a lot of other potential issues. But why they go up? It went up because people were just expecting it to be short, a V-shaped recovery, and they took a leaf out of the SARS experience. SARS happened 2 months, and then it started to bounce up. It's not going to happen this time around. SARS, for one, was very contained within Asia. The spread wasn't crazy like what we've seen over here. Right now, it's global. I feel the same thing as my friend from the Philippines, as my friend from the US, from any parts of Europe, right? And from India. So the thing that this is really a global issue is a pandemic. People are being locked down. We've never felt it before that way. And opening up the houses right now for people to go out to work, that ain't going to solve the problems because these 2 months have been very, very damaging. There has been mass unemployment. Corporates won't come back the same way that they used to. So I think that it will be a long drag. But the people that have come in are a lot more optimistic than I am, and therefore we saw this V-shaped recovery. I believe in the States, this was driven very much by retail investors buying into the ETFs. For rights issue, is selling the rights better than, worse than, same as subscribing to the rights? I think it's really specific to what type of companies that we're talking to and what kind of discount and what's the fundamentals. So there are a few issues that you need to look at before you can broad brush and say that which one is better. Because some of these companies, after they issue the rights issue, it starts to diarrhea all the way down, even below the rights issue. So hard to say to broad brush. Jane, following my first question, how the STI will perform going forward? I think it will be weaker. There will be episodes of sharp weakening, and then there could be another 1 or 2 more bear rallies along the way because there's always hope and hype, and it's great. The market should have that. But I don't think that the investors should jump into this hype so fast. Has the financial markets ever in history have such a divergence with real economy whereby the stock market is bullish when unemployment is 10% for the long term? Okay, I think let's put this in perspective. In the US, the peak in 2008, 2009 was 10.2%. And at that point in time, we don't know whether this 10% is going to last a long time or short time. Thankfully, their quantitative easing by Ben Bernanke actually worked. So it is sort of like moderated, from 10, it went down to 9, went down to 8, and slowly it improved. But at that point in time when it was 10%, we don't know how long it was going to last. So let's take that as a benchmark period. At that point in time, 2008, 2009, yes, there were bear rallies, and there were very strong bear rallies. In 2008, I believe there were 2 towards the later part in the fourth quarter of the year that we saw the markets jump by 10 or 20%. So it is not atypical of a market rushing during these periods of time. But this time around, I think the unemployment rate will be longer and will be harder. And in fact, if you look at the Great Depression, back then, when the unemployment rate peaked at 24% in the US, there were many, many episodes of bear rallies. I did mention that there was like what 20 different periods. But this one I cannot sort of like confirm the actual numbers, but I know there were quite a few during the Great Depression period when the unemployment rate was sustained at a very, very high level. And that yet there were still pockets of hopes and hypes where the markets actually jumped. Okay, anonymous attendee, the 22 million unemployed is mainly due to the lockdown. After lockdown, though, it may take a bit of time, a lot of jobs will restore. This situation is not due to financial reasons, but virus. When this is managed better, shouldn't we have a big rebound? Very good question. I did think about that. But you must also understand that many of these jobs are structural in nature. There will be jobs that will come back. Many jobs will come back, but I don't think that it's going to be the bulk of this 22 million. And 22 million, we're just scratching the surface. We're just at the current situation. Many people say that it's going to be 30, 40 million people. So from this 40, let's assume 40 million, maybe half will come back. It's still going to be 20 million people out of jobs. And many of them will be, it's structural because once the companies go bankrupt, go bust, they fire 1,000 or 2,000 guys out there. Maybe airlines or manufacturer or hotel chain. They are not. When the markets come back, the companies cannot immediately. Remember my second last slide, I was saying that it cannot be a light switch. You cannot come back from the dead again and then start to hire people. And that is why it was very important for the government to come in to protect SIA. SIA has one of the best the best balance sheets out amongst the airlines globally. But yet, the government knew that if they don't do something, there's a potential that the airline will go belly up. And even if they were to do something, one of their key considerations was to protect the jobs. That's why there's a job support scheme. 75% of them are being paid, and many of the airline staff, the crew members that are being furloughed, they are allowed to go out there to make their own money. Because when the airlines come back again, they can come back they can onboard very, very quickly. But if they go bust, all bets are off. They cannot immediately build an airline when things get better. So many of these jobs will be, I think, will be structurally struck out right now and won't come back again. There will be, yes, admittedly, there will be a lot of jobs, but it won't be the same number and it will take time. Stocks like Fraser Hospitality Trust were shut down globally means little revenue, but tens of millions of expenses. Correct. Fraser's Hospitality Trust, CDL Hospitality Trust, a lot of the hotel players, they are facing this crunch. But let's take the REITs first. You're right about them having to distribute 90%. This is part of the regulations, but a few days back, MAS actually said that they, instead of doing it within 3 months, they can do it within a year. So that gives them some breathing room, and they don't have to go back to the market to start to raise money. After they distribute it, they don't go out to raise money at very, very uncomfortable levels. So that's one good thing. I think another one is that in terms of REITs, when MAS actually changed or actually tweaked some of the regulations, another one that was key was gearing. They can actually raise the gearing from 45% to 50%. This is not exactly very, very important to the REITs right now, I believe, because many of them are still trading or still have gearings of between 35 and 38%. They're still comfortably within the limits. But I guess this is a preemptive move by MAS. And if there's more headroom, they can take on a bigger acquisition, or they can take on bigger acquisitions in time to come. Because it won't be right now. People won't be very interested in actually like acquiring companies at this point in time. I think another regulation shift that they have, or another thing that they have, like actually a concession they've made to the REITs would be the interest cover ratio. Interest cover ratio, they have raised it to 3.5 times. That's a bit more conservative than the banks, which is about 2 times. But in fact, I think most of the REITs actually are way ahead of that, are way higher than that. They are more conservative, with probably the exception of Suntech. So that's not going to be an issue. That's on the REITs front. After the MAS, I'm talking more about REITs right now, in general, because after the MAS started to institute these rules or these new regulations, there was a rush up for the REITs. But I'll advise investors to be careful, because right now you don't know how much yield you're going to get. It's most definitely going to be lower than what you're accustomed to. But the good news is that, of course, the REITs will be able to have a better chance of surviving through this route. But back to your question on hospitality trust, hotel related, yes, it's going to be terrible. And but they won't be immediately, at least, be hurt by this 90% distribution. If I were to stay invested, which sector to be in? Some of them, of course, they will help the defensive ones. But even defensive ones, there are risks involved. Sheng Siong is a good example. I think Sheng Siong has run up very, very rapidly. It went down to, I think, $1. It actually like went up on a rampage over 30%. And recently, we see some news articles talking about Mr. Lim being the new freshly minted US dollar billionaire. And they've done a lot of things right. The supermarkets have actually benefited a lot from it. But be mindful of valuations. Again, it boils down to valuations. Even though it's defensive, it can still grow during these really, really tough times, 13%. But if the valuations are rich, then you got to think again. You don't need to park money in there. You're not you are not a fund manager. You don't have that kind of mandate. Even fund managers are asking for permission to have more cash. So you don't have that kind of constraints. So you don't have to really invest in it. But then I'm just telling you, the supermarkets have done well. I think Dairy Farm has made a big U-turn after like dropping below $4. Now it's like it has also like gone up fairly significantly. The telcos, like the Singtel, StarHub, M1, many of them are very, very excited about telcos because they think it's defensive. Many of us are staying home right now, and we look at many of us are staying home right now, and then we are using a lot more data. But with Singtel, again, I feel that people have to be a little bit careful because they do have many subsidiaries that are out there. Optus for 100% own subsidiary. Aussie dollar is being whacked. Many other currencies like the rupee, there's for the subsidiary in India, Bharti, that also has some headwinds other than currency issues. So we have to be a little bit cautious. But the good news is that, of course, people are expecting it to continue to pay out the 17.5 cents dividend, and that gives you a yield of like close to 6%. ST Engineering, I mean, if you're talking about which sectors to look at, I think ST Engineering is another very popular one. ST Engineering, initially there were worries that the aerospace will take a knock. Aerospace is the biggest sector with for ST Engineering. There will be a hit because you look at it, all the airlines are mothballed. I don't think that there'll be a lot of MRO, a lot of engineering work related stuff for planes, right? So that is going to take a hit. But overall, I think because the rest of the sectors are pretty resilient, we're talking about earnings decline of no more than 15%, and the stock has also slipped considerably before making a rebound. So defensive companies like that, I think, will come into a lot of attention. Anonymous again, in short term, stock market we know leads. Yeah, it leads, but we need to know the period. If we are already very, very close, to a recovery, we can see a little bit of light. just a little bit of light, and we know that we are probably 6, 9 months away. Then to rebound, I say that that's right. Because in past episodes, if you look at always at the depth of the recession, we see the V-shaped recovery. We saw that in 1998. When did the markets recover? Right when the economy was at the darkest, August 1998. When did the markets recover in the Great or the GFC? That was in March 2009. Again, when the market or the recession was almost at its depth, just a few months out of the recession or the deepest part of the recession. That was when we did a very sharp U-turn. In 2003, SARS also we saw it in May. So March, between March and May, there was a big jump. So it is often when the markets haven't fully recovered, but when we see what we call green shoots. In this case, we have not seen any yet. In fact, we are only barely 2 months into one of the biggest into the biggest, hardest crisis, economic crisis that we've seen. How in the world are we able to foresee that the markets should be running so hard and we have really seen the bottom? In your opinion, which sectors will recover first? If you're talking about the stock market, it's definitely the front, the bellwethers, the economic bellwethers. We're talking about property companies. We're talking about banks. In the past, it was the oil and gas companies. The oil and gas companies, I think you probably have to take a few steps back because they got hit very hard because of the black swan at the start of March. Should there be any violent moves up or down, I think that the oil and gas companies, the offshore marine companies will actually tag along and follow suit. So we could still be in a recession. But if, let's say, Russia and Saudi Arabia decide to work together, then the oil prices start to spike up. I think that offshore marine will actually have a shot of being the first. But that is volatile and that depends a lot on the whims and fancies of the OPEC players. Is Singapore infra sector still going strong? Previously read the investing in Yongnam convertible bonds. Is Yongnam still okay? So is that so high? Okay, I'll take the infrastructure sector first. Infrastructure sector, there are a lot of headwinds, right? And during bad times, typically the government will come in to pump prime. Generally the mix, during good times is private sector for construction, private sector for 40. During good times is private sector 60, maybe 60%, government 40%. But during bad times, government will start to step up, and it could be 60, 70% versus, and the rest of it will be private sector. But in this case, I think the government will still continue to try to pump prime. You can see that they are trying to bring forward T2. They basically stop all the terminal to Changi Airport T2 traffic, and then they want to concentrate on it. But then with this current coronavirus episode, our foreign worker friends, they are all, I think they're basically stay home, they're under stay home notice, or they didn't lock down, they couldn't go out, they couldn't work. So there are some complications, and I think there's going to be some drag out when it comes to the infrastructure sector. We read that Yongnam got CDs, that's really true. The debt is high. It was high when I looked at it. But why did I do convertible bonds? Is because, with regards to the debt, I think that it is high, but because the book value was also fairly generous, there's a lot of steel out there, and because my portion is not very big, if push come to shove, by next year when the CD expires, they cannot pay up, they can sell off some of their steel at scrap metal price. And I will still be able to get back the money. So that's how I stay protected during the very challenging times. But if things do pick up, it could very well move towards, half its book value. I'll be happy, and then I could still make decent money. Like I said, bad times I'm protected, but if things do improve and it starts to spike up, I also get basically a bite off the cherry. what is the target for this bear rally for STI and S&P? I don't really have a target, though I feel that I feel that it will peak pretty soon because we are moving into the earnings season. Will you put money into the US or China? In both, in what proportion? Well, if I'm forced to at this present moment, then actually I wouldn't right now. But then if let's say it has like fallen to some decent levels, I believe that the US is still a safer bet. China has it can, there are wild swings. You can make crazy amounts, crazy money in China, but also because of that, I think it's very retail driven, and they don't keep for very long term, and there are many companies actually like make a surge and then they fall down or basically like come off very quickly. So I think that on balance, if you ask me, I think that US is a safer bet. Based on your analysis, best position now is to keep cash. That's right. How long do you reckon that to keep cash should be a strategy? I do believe in certain entry points, and I'm sticking to it. If you follow my first and second webinar, I did say that when it has fallen to say minus two times standard deviation on the book value of the STI, that works out to be 2,360. I would start to be a buyer of the market. I'll start to accumulate. It will not be all at once, but at every level down, I will start to accumulate. And I think that this strategy has worked for me at least in 2003 and again in 2009. So I would embark on the same strategy of buying in phases on the way down. Construction sector, I did that just now, not in detail, but like I said, I feel that the headwinds, basically the headwinds are there. The workers are not working right now. Otherwise, for the government, I'm sure that a lot of the projects that they want to do, they can actually bring it forward, and that could actually lend some light into the industry. Construction sector, even the best of times, we are looking at margins that have been very dismal. The last time that I remember, there was a big spike in the construction activity or construction stocks was in 2006 and 2007. And why 2006, 2007? 2006 was because there was a lot of en bloc activities. People were coming in, and a lot of the private developments were being built. And then in 2007, many of these contractors actually got jobs for what? The integrated resorts. There was Resorts World, there was MBS. Again, this time round, there's also new works, phase 2 for MBS and Resorts World. Unfortunately, with this coronavirus, the timeline has been shifted out. But I think if and when this thing like tames down, there could be a good possibility that the jobs will come fast and furious because they want to make up for lost time. And therefore, I think at that point in time, construction sector is something that we can possibly look at. Well, probability of a bear rally continuing for the rest of April 2020, I can't tell probabilities. Seriously, I didn't even expect it to go up so hard, so fast during the last 3 weeks. But you asked me about probability as it continues to climb. I think the probability will heighten. So it's so the probability raises when the market continues to go up, and I think that it's about that. There are a few things that can bring it down. Like I said, one of them is the earnings season. You're gonna be watching a lot of the management of listed companies come in as very clueless, and markets don't like uncertainty. And then you have big guns like Hin Leong's case. I think that's going to be very negative for the markets, particularly the banks. Yes. Isn't the vaccine coming soon, and wouldn't the market return to normal after that? I think there are a lot of people looking. The good news is a lot of people are looking at the vaccine. Very early on, China already, had mapped out the genome. I know this is very, very technical speak. I don't even understand half of what I'm saying right now. But the vaccine, even if you want to fast track, I've read reports, like I said, I am no expert on this. I've read reports, most of them sort of like conclude that even the earliest of vaccine should be the end of the year or say early next year. And even if you have the vaccine, then there will be a period of time where they need to mass produce it. Let's say it takes really fast. I don't even know how long it typically takes, but let's say within a quarter. So we're talking about, say, first quarter of next year or second quarter of next year, to have everybody vaccinated. But before that, we may just naturally recover. The risk is that the longer this stretches out, like we said, it is minimum basically like 9 months more out there. How long can the economies, the global economies tahan all these things? I say not much longer. Already 1 month we are crying. Another 6 to 9 months, that will be very, very damaging to the economies of there. US curve in New York seems to have flattened. Yeah, I've been watching the US numbers. It has. I mean, the death rates have come off. The number of infected people are still amazingly high, 6,000 people, which amazes me because, isn't the whole city or the state in a lockdown situation for a long time, right? There's still thousands of people being infected. But the good news is it has flattened. The drug seems promising, but I said the vaccine will take a while. Even if it is being approved, it will take, and it's fast track. It will take a while before people will be able to get this vaccine. And one of the things that I've read is that this group of Harvard professors have been saying that there could be, globally what we're going to see is that there's going to be lockdown, then they're going to release the people. There's going to be the lockdown situation is going to release people, come back to the society, and when the hospital and when we cross and these people get infected again, there's more people getting infected. They go to hospitals, the medical facilities cannot take it anymore. Then they do another lockdown. So there's basically like different periods of lockdown over the next year before the vaccine gets found. I think that's scary. That's scary. But flattening of the curve, I said, and I do want to stress like what I did over the last 40 minutes or last 50 minutes, that flattening of the curve is not good enough right now because our economy has already been hit. Right? It's just a matter of how bad it is. So the faster we flatten it, the more we stay at home, the faster we flatten it, the quicker the recession can be over, or the shallower the recession. But as it seems right now, the recession is going to be very, very hard, at least for this year. And I don't think that we understand the magnitude. Even as I'm talking, I think it's bad. It could be even worse, right? We don't understand how bad the situation is right now. So, like I said, if you don't understand, then you just be conservative and don't do very much right now. And you bank on worst case scenario before you, or the very, very bad situation, the kind of marker that I said 0.8 times price to book before you re-enter the market. Look at Berkshire Hathaway. Charlie Munger was just saying that he doesn't even know how deep it is. And therefore, even with him having the gigantic elephant gun of $128 billion in cash, he's not doing anything right now. Do you think we should sell some of our stocks to buy back later at lower prices? I think that there's a good opportunity for you coming to buy back at lower prices. Suliang, what are Singapore listed companies that you think in your opinion will suffer from Himyong collapse? Also, the foreign workers in Dom now all stop work. So, which construction and property development companies will be badly affected? Very good question. Himyong, off the bat, very easy. The banks, DBS, UOB, OCBC, all three have exposures to Himyong, and it is not just Himyong itself, but it's other reference in the same industry. If Himyong being such a giant can face such problems, what more the smaller ones, what more the minions. I think that that's something to look out for. And other oil and gas casualties out there. But we don't only like look at the oil and gas sector, but I believe that many other sectors will face very very harsh impact because of the virus. Foreign workers in dorm, I believe that some of the listed ones will be Centurion. That's obviously because they are out and out dorm players. Lianbing has a Lianbing has a joint venture with Centurion in one of their dormitories, and that I believe will also be there will also be an impact on it. Some of the property developers back then, like okay, King One is not exactly a property developer; they are M&E specialists, but they also do some property development, and they saw the opportunity in dorms because dorms at one point in time gave very very good yields. Not uncommon to see 10 to 12% yields. In fact, in 2007, when this was still a burgeoning industry, we're talking about in the teens, easily in the teens. So there were some property developers with some exposure, including King One, in this particular sector, and I think that all of them will feel the heat. But of course, if you look at the mid to long term, companies like Centurion, I believe, can potentially be a beneficiary. Not now because it's right in the eye of the storm, but potentially be beneficiary because the government, Josephine Teo already spoke about it, they are very, very committed to actually improving the lives of our foreign workers. So that would mean possibly more space for them, and because Centurion is a professional at this, I believe that there's going to be more demand for their facilities, and there's going to be more. It's going to be more spaced out. They may have to spend some money to build new dorms. They've already held their plans, but I think going forward, like I said, in the mid to long run, they will be a beneficiary of that. Construction, very, very tough, as well as the construction and property development companies. Right now, they're trading, I think, 0.7, 0.6, 0.7 times the price to book. Palatable, but given the onslaught of negative news, I'll hold back until possibly a better time to invest in them. Hi, Terence. Does the price movement of the S-REIT sector, even those of the industrial REITs, correlate to the price movement of the STI? Bearish on STI means more downside risk to the S-REITs prices. I'm not sure about the data right now. At one point in time, the REITs were not supposed to move that much in correlation with STI. But given that more and more REITs are being introduced or being welcomed into as part of the STI components because they meet their market cap, they meet their liquidity requirements. So many of the REITs are already STI components. So more and more they move towards the beta or being correlated with the STI. As REITs will have their own risks, as I mentioned earlier on, because of all these shifts, allowing them to push back their dividend payment or their payout, the 90% payout, that would possibly like lower the yields. And why do investors want to buy into REITs? All through the story, since the first REIT in July 2002, the CMP, people want regular income, safe and regular income. And you're not going to get that. I think that there is a potential for a sell down. We've seen that it is not something without precedent. We've seen that in 2000 and 2009. Remember at one point in time, the cycle of the REIT, CMP was trading 12% yields when the prices started to, or the stock price started to plummet. Okay, I just have time for one more question. I'm just gonna like look at could be developed, could damage some will still this one I've answered already. Soon contained by June, July. I'm just gonna like pick up one representative question for a final one. Go. For the wildfire still the time. Okay, I guess the final word will be still, should we take holding back? What do you think this means that could be a good price for? Assuming the COVID-19 is contained by June, July, with all the government stimulus package, based on the stock market forward looking by 6 to 9 months, when do you think we should buy in? Okay, I think that many people have concern about how to time the market. I really, like I said, I really can't tell about timing exactly when to buy, but I do have, like I said, markers to come in at every stage, and I still maintain the markers. There could be certain things that will actually change my opinion, but as it stands right now, it's no different from 1 month ago. I will buy in at minus two standard deviation. That's 2,360. I'm all mentioning STI right now. When forced to minus 2.5 standard deviation, that's 2,100 on the STI, and forced again to 1,800. That's minus 3 standard deviation, which is something that you go, wow, minus 3 standard deviation. If you look at the stock chart with respect to price to book, we have I don't think like over history we have like seen minus 3 standard deviation. But again, these are unprecedented times. I feel that a lot can happen to the earnings of the companies because these earnings, like I said, um, can be totally wiped out, in the next 1 or 2 quarters. And analysts are still extremely, I feel, are still extremely bullish. They're just like reducing the earnings by 10, 20%. And they call a slashing of earnings of the, minus 30%. That's a slashing of earnings. But a real slash in the earnings is like, it gets totally wiped out and it reverses its position from profit to losses. Many companies will face that. And therefore, I feel that there's a good chance of it coming off, the market coming off before, revisiting its highs. You're not too late. People that have not participated or feel that, we have already like missed the major run right now. Maybe it's too late. It's not too late. You just got to wait. You just got to wait because the markets are going to come off. There will be better opportunities sometime in the very near future. Okay, I think it's 1 o'clock right now. Ethan, you still there?
Yep.
If you have
Thank you,
any questions,
Terence.
you can always
Yeah.
like email me or go to my Facebook or investing note page.
Yeah, thank you, Terence. It was, very insightful live commentary. Thank you, everybody, for putting in questions. I think Terence answered about 20 plus questions non-stop as well. All right. So thank you, everybody, once again. So the market is right now open already. So we will stop the webinar here and we'll look forward to the next live market commentary with Terence.
Okay, thanks, Ethan. Thanks, everybody.
Okay. Thanks, everybody.